All right, let's go through this. So we're going to do a volume part 2. Peep the new deck. It's different colors. Okay, so once again, this is being recorded. If you don't want to be in the video or if you don't want to be heard or whatever, you just don't fucking talk right now. Okay, we're going to go through this entire thing. It's only going to be about 10-15 minutes. We're going to talk about it afterwards. Everybody that's gone through the class, everybody that's been in the group for an extended period of time understands that the majority of what we do inside here is based off of work done by Bulkowski. If you don't know who Bulkowski is, I want you to Google him afterwards. He is more or less the modern version of the king of technical analysis in that he has been able to quantify so much of the data that we take for granted. He is the most quoted trader throughout the majority of the CMT material. And he does keep an active website, even though it looks like it's from 1995, that holds a lot of his thoughts, a lot of his new information, and it would take you weeks to go through his entire all of the stuff he has updated on there. I know because I've gone through a majority of it. This is a piece that I just went over. I was talking to Mike about it. Some of you guys were in there, so we're just going to run over it because it's directly applicable to what we are seeing right now, and it will in one way or another help you guys identify and hopefully profit better within your trades. What's up really quick, Kevin? ThepatternSite.com, I believe. Okay. So first things first, volume study. Summary. So here are the results of the study on volume for chart patterns, not candlestick patterns. That's super important. It's only chart patterns, which says that the move after a high volume breakout isn't as impressive as many believe, which struck me as odd because one of the first things you learn when it comes to trading is that volume typically precedes price. And although that's not invalidated through this study, it definitely leads you to believe that maybe some breakouts on the high volume should not be weighted the same as others. Failures double and the likelihood of a throwback or triple or pullback triples. You guys understand what throwbacks and pullbacks are. A throwback is when something breaks out to the upside and then throws back rather towards the resistance turn support. And a pullback is when something breaks to the downside, price pulls back to support turn resistance. Number one, this is a summary of the entire study here. An upward breakout on above average volume propels the stock higher by just 1.8 percentage points. We'll go over all of this, but just really quick. Number two, a downward breakout on above average volume sees price drop by 0.6 percentage points less. Number three, failures nearly triple after an above average volume breakout. Number four, failures more than double. He misspelled that. Just copied and pasted here. Double for downward breakouts too. Number five, price is 3 times as likely to throw back or pull back after an above average volume breakout. So all 5 of those points definitely leave us wondering, is volume or high volume breakouts or breakdowns, are they actually worth it? Should we possibly think twice next time we look to enter on breakouts or breakdowns with high R-vol, something that we've done for a year, something that I've done for years, and something that I believe most traders, even experienced traders, look for. So we're going to go ahead and throw a monkey wrench in that entire idea here. Really quick, this is important. The study that he did does not encapsulate everything, and so I want to show you guys some of the pitfalls that maybe he overlooked with this study. So first off, it's 100% done on the daily time frame. So none of this is directly applicable to scalping. None of this is directly applicable to day trading. Now, I don't want to say it's not applicable. I mean directly, as in his specific study only dealt with daily candlesticks on the daily time frame. All right, so having said that, he went through 8,000 charts from July 1991 to May 2011 with 8,000 different trades on those charts. 3 different types of patterns he used. That's it. Rectangles, double and triple tops, and bottoms. That's it. Those 3 types of patterns. No symmetrical triangles, no ascending triangle, nothing. Just those 3. Rectangles, double, and triple bottoms and tops. Now, why? Go to number 4. Because they're defined breakouts. He focused on horizontal level breakouts and breakdowns, no angled areas. Why did he do that? I'm going to assume it's because symmetrical triangle breakouts and things that have angled areas are subjective, right? I might draw a slightly different angle than Mike, and Mike might draw a vastly different angle than RJ, etc. These horizontal level breakouts and breakdowns are very clearly defined. You're not going to find a whole lot of variation with those. 5, he's using his above average volume from a 31 calendar day. So in the examples that I used towards the end, I changed my moving average across the volume histogram to match his, just so we can get a direct view of what he was looking at. We normally use the 20 moving average. He uses the 31. Really didn't matter a whole lot, but I changed it for this example. Number 6, ultimate high. He uses this frame. I don't think I ever used it again in the slides, but essentially it's the highest high that price made before dropping. That's it. And he uses the metric of 20% as essentially the trend changing. The ultimate low is the exact opposite. It's the lowest low that price makes off of these breakdowns before it once again pops back up for at least 20%, so the trend is changing. And then the last bullet here, performance. He used the ultimate high and low to gauge post-breakout performance. So we're not going to see those two words again. Just understand moving forward, the highest high is the ultimate high before it drops 20%. The ultimate low is the lowest low before it rises 20%. All right? Let's look at the results. On breakouts, above average volume breakouts showed price climb of 37.6% on average before changing the trend. And like I said, that's before dropping at least 20%. Below average volume breakouts showed price climb 35.8% on average before changing trend. So high volume breakouts improve a trader's average profitability by only 1.8%. That was surprising to me. I don't know about you guys, but this was very, very surprising to me that on average, only 1.8% difference between high volume breakouts and low volume breakouts. I was always taught that high volume breakouts had an obscenely high, at least higher chance of confirming than lower average or lower volume breakouts. But Bulkowski here shows over 8,000 different trades, profitability only differed 1.8%. On breakdowns, above average volume breakdowns showed a price loss of 15.1%, whereas below average showed a price loss of 15.7%. So there you go again. As a matter of fact, high volume breakdowns reduce a trader's average profitability. It reduces it. So over 8,000 trades, I'm not sure what the skew was between breakouts and breakdowns. He didn't say. But on his shorts, on the things that broke down below support levels, he actually saw a worse profitability on high volume than he did on low volume. So once again, completely different from anything that I ever thought about, and completely different from, I don't think I've ever heard anybody actually say this. I've gone through courses and stuff. I've never heard anybody say anything like this. So something to keep in the back of your mind here, that high volume breakouts to the upside only performing marginally better, and high volume breakdowns are actually underperforming. Okay? Failure rates. This is important. Bulkowski measures a failure rate by 10%. Let's see, measuring the 10% failure rate, which asks how often does price fail to move more than 10% after a breakout, shows that failures occur more often after a high volume breakout. We were just talking about that. But he goes into more detail. On breakouts, a failure rate is observed 14% of the time on above average volume. A failure rate is observed 5% of time on below average volume. So almost triple. On breakdowns, a failure rate is observed 28% of the time on above average volume. A failure rate is observed 11% on below average volume on breakdowns. This is incredibly useful knowledge and completely different from not only what I taught the majority of you guys, but what I fucking knew. And I've never heard anybody other than Bulkowski put this out there. So I'm definitely going to dig more. But a failure rate is observed almost 3 times as high on above average breakouts to the upside, and more than double on breakdowns to the downside. Chart patterns with above average breakout or breakdown volume are at least twice as likely to fail than those with below average breakout volume. Now, at the end of this, we can talk about why maybe this is happening. Mike actually talked about it when I very first started bringing this up. But this is important stuff to understand that these high volume breakouts and breakdowns might be sabotaging traders. And I'm going to actually ask Mike at the end, because he came up with one of the keystone concepts that I could think of, maybe why these high volume breakouts and breakdowns are actually tricking traders, quote unquote. Let's talk about throwback and pullbacks really quick. Price is 3 times as likely to throw back or pull back after an above average volume breakout. On breakouts, throwbacks occur 57% of the time after an above average volume breakout. 18% of the time after a below average volume breakout. That's big. 57% of the time, that's more than half of all breakouts experience a throwback on above average volume. I didn't know that. That's an edge. A casino will make $1 trillion with 57% on their side. On breakdowns, pullbacks occur 47% of the time after an above average volume breakdown, only 17% of the time after a below average volume breakdown. So what is all of this telling us? It's telling us that these above average breakouts and breakdowns are actively working against traders that are trading high volume breakouts and breakdowns. The stats are there, at least with this 8,000 trade data set, that absolutely high volume to the upside and downside are sabotaging traders that are trying to trade these breakouts and breakdowns if they don't understand that the throwbacks and pullbacks are not in their favor. Pullbacks obviously at 47%, so it's not as high, but 57 for sure, most of us are trading to the long side anyway. So I want to introduce this concept we've talked about. I did not come up with this for the millionth time. I don't need somebody in here to tell me that I stole this. It's called the BRB setup. It's a breakout, retest, bounce. The BRB setup is a trading setup that we use frequently within the trading initiative that takes advantage of the underlying thesis of throwbacks towards resistance turn support, right? A lot of the time you'll hear, Mike says it all the time, I say it quite frequently, if we get a breakout and then a throwback, I say pullback, I interchange those, it's a bad habit, but the throwback back towards resistance turn support, that might be the opportune time to actually get in. If you did not get in on that breakout, you did not get that small little pop off of the resistance now turn support, we can get in on the throwback towards that resistance as we get down there, engage that area again. So armed with this updated information, we should be able to more accurately time throwbacks by correctly identifying high volume breakout areas on setups that we traditionally trade. What does that mean? For example, you're looking at a chart, you missed the breakout. Instead of FOMOing in a day or two later, what could you possibly wait for? Well, if you have an overwhelmingly large amount of profit or percentage or whatever you want to call it, probability, there we go, of it actually throwing back, wait for the throwback. You might actually be getting a gift instead. You might have traders that are trapped up at the top there that chase the trade. Now it's pulling back. They might start capitulating and you might get your resistance turn support grab before it takes back off. And we're going to look at a few trades that actually happened. First things first, Facebook. Don't want to talk about Facebook today, but it did hit an all-time high today. We talked about this quite frequently over the last 2 weeks. This is the #1 hedge fund stock right now. And Facebook is at an all-time high as of today. But if you look at that green arrow, this was the original breakout in the BRB setup. Retest would be the exact same or near the same breakout spot. You can see Facebook broke out. If you want to gauge the Fibonacci levels, that's fine, but we broke out somewhere around 278, 280, high volume. I didn't label it down there, but you can see that the volume is higher than usual. That's the 32 or 31 rather. Calendar day. Moving average. It pulled back damn near to the exact same spot that it broke out, and then it took off. BRB setup. Breakout, retest, bounce. This is exactly what Bulkowski was talking about. When you get high volume breakouts to the upside, overwhelmingly at 57%, they come back and retest that same spot. Next one, GDX. Almost the same goddamn setup. We broke out, high volume, came back and tested the exact same spot, and then we took off. These things happen. These are just two off the top of my head that I was putting together. I guarantee you've traded something like this frequently, or not frequently, but recently rather, that also had the same sort of setup, right? You don't need to tell me what they are, but I'm sure you guys have a ticker in mind that you traded. It immediately came back to where you were at. You either got stopped out or you held through the loss if you're in an options position, and then it took off. We've all experienced this. Bulkowski is the first one that I've seen put stats behind it. So, closing thoughts on this, and then we'll go over it, and we'll go over some other stuff too. After a high volume breakout, the move isn't much better than after a low volume breakout. Failures increase. Many are taught to avoid a low volume breakout, like myself, and what I've imparted onto you guys up until today. And the likelihood of a throwback or pullback triples. Now, throwbacks and pullbacks rob the stock of momentum and performance suffers, but having said that, That does not mean that if they come back and retest those areas that they originally broke out of, they are not going to bounce, right? It just means on that original wave up, obviously a throwback is going to rob, or a pullback is going to rob the momentum of the underlying. Okay, so once again, the move isn't much better after a low volume breakout, right? High volume, I believe, is only 1.8% higher, but failures increase at 57%, or throwbacks rather, 57%. Failures increase as well. We can go back and get those numbers one more time because now I'm mixing them up. There we go. Failure rate of 14% and a throwback of 57 on above average volume, compared to 5% failure on low average volume and only 18% throwback. That is a significant difference. 57 to 18, 14 to 5. Over 50 to 100 trades that I'm sure we're going to make over this year. That is a statistical advantage if we understand that these percentages are working against us. All right?